Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Thank you, and welcome everybody to our April instalment of the FX webinar series. So the question that we're asking today is about the rise that we've seen in global yields and the response that we've seen from some central banks to that rise in global yields, and whether that response was merited or indeed whether that response that we've seen is unwarranted, given the fact that what we're really seeing is a recovery in the global economy. So if we look at the slide set and we look at the contents of the slide, we're going to do a quick review of what's happening with regard to infections and vaccinations, and then we'll get into the meat of that question about rising yields. Has that rise been arrested by the actions that we've seen from some central banks, or do we expect to see further rises in yields, and what will that mean in terms of the economic response? We'll also look at growth expectations, which is timely since we've just had the IMF's numbers released, and then we'll look at fiscal policy. One of the things that we've seen announced since the March webinar has been a significant change of direction as far as fiscal policy is concerned in some areas. So if we move on to the next slide and look at first the infections data that we've had being released over the course of recent months, or recent weeks and months rather, and what that demonstrates is that those countries that seemingly have got a more developed and more mature vaccination program are seeing a general decline in rates of infections. The UK on this slide is the best performing, but obviously if we were to include countries, some of those in the Middle East, the likes of Israel as well, then you would see the rates of infections there even lower. And that's despite a much greater unlocking of some of those economies. The infection rates in much of Europe are rising, I think, predominantly because of seasonality more than anything else. At this time of year, there's a greater prevalence of respiratory diseases. And so consequently, similar to what we saw in the initial phase of the pandemic, you are seeing a rise in infection levels, but you have seen a reaction to that from a number of governments in Europe. So you would expect those to peak over coming weeks and then start to drop away. And again, as the weather improves and as it warms up, you'd expect those rates of transmission to drop back. The other point to note as well is that...
Yes, I am. Apologies. I think you lost me there. I think my broadband has just dropped out, sadly. So I'm not sure where we got to, but I'll just do a quick review of that first slide, just talking about the numbers that we would expect to see, the numbers of infections dropping across Western Europe as the weather improves, and that will allow for a reopening of economies into the second quarter. And the good news is that even without that reopening of the economies, what we're seeing at the moment would seem to suggest that economies have held up better than they held up previously in previous lockdowns. So on a services and manufacturing basis, you're actually seeing an expansion across European manufacturing. On a services basis, you're seeing quite a sizable expansion in services in the UK over the last month or so. And in Europe, they're getting back to almost a rise in activity. You're still seeing a small contraction, however. Q2 should see the economic activity rates pick up sharply, and I would anticipate that any lost economic output in Q1 will be recouped in the second quarter. That's regardless of whether you're talking about the UK or Europe. And we would expect to see the US building on their recovery in Q1 into the second and third quarters, although the pace of economic activity may well slow from there. Why is that? Well, if we move on to the next slide, then this shows COVID vaccinations and the numbers per 100 of head of population. You will see that all of these are moving in the right direction. The angles are starting to increase as well. It's even improving in the European Union. That's come in for some criticism in the UK media. And I would expect that the second quarter will see a lot more vaccine doses delivered to the European Union, and that will help the Euroland recovery. So they'll start to catch up what we see in terms of the rapid pace that we've seen from the likes of the US and the UK. There's going to be more choice on vaccines as well. You've got the Novavax vaccine in the UK potentially being given approval by the MHRA as soon as the next few weeks. You've got the Johnson & Johnson vaccine that's coming on stream for Euroland at some point in the second quarter, hopefully early in the second quarter. Moderna has just started being used in the UK and again will likely be used in the European Union over the second quarter. So there's more vaccine choice and therefore more doses that are likely to be on offer over the course of the second quarter and into the remainder of 2021. So that's the positive news. That if we now move on to the next slide and look at yields, that could be responsible for the rise that we've seen in yields. So whether it's 5-year yields, 10-year yields, or even longer dated yields, you have seen an increase in the cost of borrowing for governments across the board, and that acts as a bellwether, acts as a benchmark for corporate borrowing costs as well. So you're seeing that there is an increase in the cost of borrowing, or there has been an increase in the cost of borrowing over the course of the last few months. Now, the interesting and intriguing thing here as well is that you haven't really seen a significant divergence between the longer dated yields and the shorter dated yields. So what this suggests is that from a market sentiment perspective, there is going to be a relatively rapid recovery in most economies, and that recovery is anticipated if you look at the Bank of England or the IMF or other austere forecasters and revered forecasters. They're suggesting that you're going to be able to recoup all of the lost economic output for all of these economies by the end of 2022, and in most cases well before that. So in the US's case, the expectation is that the lost output will be recouped before the end of this year. In the UK's case, the Bank of England are suggesting that by the end of the first quarter of 2022, the UK will have recovered all of its lost output as well. And even in Euroland, it's only a quarter or so later before they recoup all of their lost output. So that rise in yields is probably down as much to that confidence about economic recovery as it is about fears over inflation. But I do think that there are some fears over inflation. We saw it, for example, in some of the PMI data, that input and output prices do seem to be rising. And there is a potential short-term hit to inflation coming from this recovery, where supplies might actually be under some pressure compared with demand. Over the last 15 or 20 years, it's been the case that supply has always outstripped demand, which has helped to keep prices low. But over the course of at least the next 12 months or so, we could see an uptick in price inflation pressures, which could further increase yields from here. There are things that central banks could do, and we've seen that. For instance, the European Central Bank has accelerated the pace of its asset purchase program for the next few months at least. You've seen that discussed by the Federal Reserve and the Bank of England. They chose not to do that. You saw the Reserve Bank of Australia do a similar thing to try and arrest the rise in its yield curve as well. So it is possible. It is within the realms or the scope of the current policies that they have in situ for central banks to be able to arrest rising yields. The only question is, will that actually reverse the trend in rising yields, or will it just postpone it, delay it for a further few months or quarters? And I think it's much more the latter, which is why you've seen the Federal Reserve and the Bank of England somewhat reluctant to get involved in intervening in bond markets more aggressively than they already are, to buy themselves only a few months or a couple of quarters of time before yields rise anyway. So I don't think we're going to see more activity from central banks with regard to this, and you could see a further upward drift in yield over the coming month as we get building expectations and solid evidence of the economic recoveries in situ for all of these major economies. So if we look at the next slide, and that's looking at growth and how it will perform against expectations. Well, growth is expected to be robust in all of the major economies, according to the IMF's January forecast. Now, it's worthwhile mentioning that the UK growth forecasts have now, for 2021 and 2022, both been revised over 5%. UK growth in 2021 is now expected to be, I believe, 5.3%, and in 2022 expected to be around 5.1%. So a more robust recovery, according to the IMF, but that's still not as robust as the Bank of England and I believe the Office for Budget Responsibility expect the economic recovery to be. As for the US, and less so for Euroland, I think the US is going to struggle to maintain the pace of economic recovery into the later stages, the last few months at least of 2021, because it will probably have picked all of the low-hanging fruit by that point. And the likelihood is that growth in 2022 for the US is going to be far more disappointing than we are likely to see in other economies. Worthwhile mentioning as well that for Euroland, the growth numbers were revised up only marginally, so from 4.2 to 4.4%, from 3.6 to 3.8%, so a much lower rate of economic growth than we're expecting in the other two major economies that are highlighted here. There is one other sort of question mark, because if you're expecting a relatively rapid recovery and recoup of lost economic output, why then are the labour markets not expected to recover anywhere near as quickly? And the simple fact behind that is that ultimately the labour markets are in part being replaced by automation. The output that's lost isn't necessarily the output that's being added back, so there's some change in behaviours that are taking place. But businesses have found that they are able to operate more efficiently with a lower workforce because of COVID, and as a consequence will not necessarily be employing the same number of staff back. But I just want to highlight one specific point in those points that I've emphasized, which is the change in behaviors. You know, if you look at the numbers out of the UK retail sector, as an example, the change in behaviours that we've seen from the consumer are that they've been shopping less frequently, but they've been buying more. And also, the biggest change in behaviour is how much more they've been buying online. So we've seen this in terms of the figures from the Office for National Statistics, that internet sales as a percentage of total retail sales prior to the pandemic were running at just sub 20%, at around 19.1%. They reached a peak in January 2021 of 36.3%, falling back to 34.5%. One would anticipate, even with the reopening of retail, that the percentage of total retail sales that are internet sales is going to be at least in the mid-20s by the time all of this is over and done with. And again, that will seriously affect the amount of people employed within the retail sector. And that's despite the fact that I estimate that there's somewhere in the ballpark of £60 billion of additional funds available to consumers to deploy once non-essential retail and services are reopened. And that will be one of the key triggers for the UK's recovery. And that's one of the reasons why I think the UK could outperform expectations and probably has more likelihood of outperforming expectations versus Euroland and the US. You know, the US, the economy hasn't been locked down for any length of time. There hasn't been, apart from the individual stimulus packages, which are temporary, a significant boost to the consumers' firepower that they can deploy in terms of spending more to lift the US economy to stronger rates of economic growth over the course of 2021 and beyond. I just wanted to now look at the next slide, which is fiscal policy. And we have seen some significant changes with regard to what fiscal authorities like the UK Treasury, like the US Treasury, and like the fiscal or finance ministers of the European Union have talked about. And they're all talking about not only higher levels of spending, but also higher levels of taxation. So this chart, which I've taken from the OBR's March report, shows where the UK was in 2009 on corporate taxation, where they were in 2017, and where they're expected to be as far as corporate tax rates in 2023. You see that we don't get back to where we were prior to the big cuts that we saw brought in by the previous Conservative administration under David Cameron. However, we are expected to be much further up the spectrum as far as corporate taxes are concerned versus our near neighbours and versus our competitor economies across the West and also into Latin America and also in Asia. Now, here's the other thing that I think is interesting. This chart doesn't include the multi-year, in fact, multi-decade US president's plan for economic transformation. The jobs and investment program that he launched it last week, that was worth $2.25 trillion upwards, and is going to see corporate taxes rise from current level of 21% up to 28% over 15 years. You know, what this suggests is that fiscal policy is going to be more interventionist than it has been previously. So this is a big sea change in terms of how governments consider fiscal policy over the course of the next decade or so at the very least. They're going to be more receptive, more open to raising taxes and using the monies from those tax increases in order to support larger amounts of government spending in specific areas. And so that's whether that's the UK or whether that's countries across Euroland and the European Union or into the US. I think we will see Western governments take a more interventionist approach as far as fiscal policy is concerned. And I just thought that in terms of the rising yields debate, the potential for that to further increase yields, I think, shouldn't be overlooked. So we've got a two-pronged attack here as far as yields are concerned. There's going to be a reduction in the amount of monetary support to try and suppress yields over time, over the next sort of 2 or 3 years. But there's also going to be a lot more fiscal spending, driven in part by tax increases, than we've become used to as well. So just watch out for that in terms of its effect on yields, because I think it could be fairly substantive. Then the final slide is the FX forecast slides as we would normally indicate, and this shows that our views haven't really changed that much, although we have become a little bit more positive on sterling. Why is sterling expected to be a bit stronger against the US dollar and also against the euro? Well, simply the UK's vaccine program is more developed than it was anticipated to be at this juncture. Most central expectations were not for the UK to be this far along in terms of vaccination. So we've beaten those forecasts, which means that the strength of the recovery, as evidenced by the IMF's numbers, is likely to be greater than it was previously forecast. The other thing that I would highlight with regard to this is we've got a slightly lower peak in euro dollar. The problem with that is that the problem with the euro is that I think that they are potentially going to be an outlier versus the UK and US in terms of their policy. I don't think that they're going to be able to ratchet back on public spending quite as quickly as the US and UK do, and I also don't think that they're going to be able to relax from the monetary loosening that is already in situ, mainly because they are going to be at least a couple of months behind as far as the vaccine program is concerned, which means that they're going to miss out on quite a sizable portion, if not all of the summer, in terms of the growth that we're likely to see there, and they could well be more cautious with regard to the progress of the Euroland's recovery and the vaccination program going forward. So just I think there is room for a slightly weaker euro than we've been previously forecasting. And finally, we have revised our forecast for things like dollar yen, just in light of some of the troubles and difficulties that we've seen in Japan lately. I think that does support a weaker yen against the dollar and against other majors, not for the foreseeable future, but for the next few quarters at least. And of course, one of the big pluses that was expected to be seen for Japan over the course of this year, meant to be last year, is the Olympic Games, which are due to be held in the late summer. Now that might cause some real difficulties for Japan if, and I stress the if it is either only domestic audiences that are allowed to attend or no audiences at all, as in that the vaccine program is not sufficiently advanced to allow there to be any mass gatherings. That can have a significantly negative effect on expected revenues from the Olympics and therefore have a negative effect on the Japanese economy. So that's just another reason why we've highlighted that. And then, and this is finally, as far as this forecast table is concerned, we would anticipate that the emerging markets will remain weak. The figures still suggest that there's a significant portion of lost output that won't be recovered this year or even into the whole of 2022. We have seen pressure, for example, on currencies like the Turkish lira. Now that is down to excessive inflation and political interference at the central bank, but I think it's also down to the lost economic output. And again, if they lose a sizable portion of the summer months or all of the summer months because of the problems around COVID, then that could have a significantly negative effect on their economic recovery going forward. So, that's just one final point. I would also argue that emerging markets will be hopeful that the Western economies do follow through with their promises on vaccines and global vaccine programs. Thus far, I think because Western economies are falling behind, or some Western economies have slipped behind where they would want to be, there isn't necessarily going to be the same level of vaccine benevolence as one would have expected previously.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.